what would your moves be if the market did deteriorate and got worse?
Yeah, that's a good question. This came in earlier this week, and basically, how do we get more defensive if the market continues to do poorly? What do we do, and how do we continue to do that? And so you have to understand what defensive means. First of all, for most clients, they already have a targeted mixture. 60% stocks, 40 bonds, 80 stocks, 20 bonds, or 20% stock, 80 bonds. So that's important. So there's already a defensive mixture of some type built in automatically from day one with each one of the accounts. That can change over time, but that's there. And so really what we're talking about is just the stock market portion here, because there's, for most of our clients, our average client's about 60% stock and 40% bond. So for most of our clients, they already have a defensive position in their portfolio with these bonds, which should hold up a lot better than the stock market and possibly even go up. We'll see. I mean, this is a default on the bond market. So how does that affect that? Again, this has not happened before. But when you look at the stock market, there's three different ways of getting defensive. Number one is you can move into more defensive stocks. And so these would be things that don't drop as much usually. So for example, people still need food. They still need toilet paper. And so companies that produce these, what are called consumer staples, often do quite well in downturns in comparison to the market. They might not go up, but they don't go down as much. And utilities sometimes you'll see as a safe haven, because again, they have monopolies, people still need heat and, water and those type of things. So there are different pieces that you can move into that are defensive in that regards. And we actually did that to our portfolios, over a month ago, back in, August, middle of August, we got more and more defensive just because the market had gone so many days in a row without any really big downturn. It just seemed like that was somewhat inevitable. Wasn't expecting this debt ceiling issue, although we did know about it. And So that's one piece. So you can overperform the overall market there if it does come down just by having, some more defensive pieces. The next thing you can do is essentially kind of moving out. You can move out to a money market. I tend to like something like an ultra short-term bond fund, makes more money than the money markets as far as that goes. And, we can buy and sell these exchange traded funds without any commissions. So that's good. It's easy to move in and out of them. So that's the first would be possibly defensive stocks like consumer staples. Next would be, getting out of the market, adding to your bond position, for example, and then hoping to go back if things get lower. The last thing that you can do is actually move into holdings that go the opposite direction of the market. So they have these inverse positions, like the Pro Shares has one, ticker symbol is SH. It's a um, an exchange traded fund, an ETF that is designed to go exactly the opposite direction of the S&P 500. These aren't great long-term holdings, but they can help to solidify some of the losses that you might be having. And I tend to go down that spike. And the last thing I look at usually, and I didn't mention it because I'm probably not going to consider it this time, are long-term treasuries. It's what we did in the 2020 downturn, and that worked fantastic. But this particular downturn, if it got that severe, could be because they're defaulting on treasuries. And I have no idea how the treasury market's going to react to that. So I probably stick to those first three categories. And again, I only move into those as things get more and more severe. We don't do this very often, that's for sure. And again, I wouldn't normally, do this, but we had a 35% downturn in about 6 weeks last year. Had to get a little bit defensive there somehow. And then secondly, was that, you know, debt ceiling issue it's a big one. It's a different story. It's definitely a problem. And one of the problems you have to understand about the debt ceiling is we don't really know what's going to happen. So, for example, in 2008, when everything started, it really some of the companies were defaulting and having trouble, like Lehman Brothers, and so they didn't bail Lehman Brothers out. It was 150 billion that they needed to bail them out. And what people didn't realize, there was all these other dominoes sitting next to Lehman that nobody really realized. And when they folded, boom, 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 all these dominoes are falling. So if they default on the debt, that's a big issue. what are the dominoes? What's sitting out there that's waiting to fall based on that weakness that could happen? So that's where you get more and more defensive just to try to protect yourself. One of the things about retirement, in my opinion, is that you can't really suffer a 14-year downturn. You can't sit there. I'm a big buy and hold believer, but the depression, the stock market dropped 86%, and it took 14 years to come back. You can't go through that as a retiree, believe me. So that's where you want to be a little bit more cautious in these more extreme situations. The rest of the time, you should really just be buy and hold with some small movements of some targeted indexes. Then that seems to work pretty well. But this is one of those situations to watch out for. And I'm not trying to scare people here because I really don't think it's going to happen. I actually think what we've already done should be enough. And then we'll be able to come back in. I'm just hoping to be able to buy at a little lower point and buy some good quality things, buy some broad stock market pieces, and once they resolve the debt ceiling, I would suspect that things could really jump because everybody's going to be trying to get back in at one time because they're being compared to a stock market index, and they don't have everything in the stock market right now. So anyway, that is what's kind of, in my opinion, a strategy to take a look at for getting more defensive.
Yeah, just like a earthquake emergency plan, you have the emergency plan ready and you just hope you never need to use it, but you don't want to be panicking when there
Yeah,
is the actual
yeah,
emergency.
yeah. I think, and well, I think this is where somebody like me and our business comes in. This is the value that we add. We have a plan. We've been through it before. We did, I think, fantastic last year in the downturn. I'm ready. I've got all kinds of different strategies. Unfortunately, these big downturns are becoming more common. I don't think this is going to be one, but if it does, we do have a plan. And I actually look at this as opportunity, and that's what helps me a lot mentally. I think there's a chance for us to make money here. And so, I'm always looking for that chance. And that's what we did last year. I mean, we bought Apple on the 5th of March. I think it's up 143% in our taxable accounts. And so, those chances and things that we can take a look at. I will put one other piece out here, which I do think is important, is if you have what I'm talking about mostly applies to accounts that aren't taxable, like IRAs or 401ks or Roth IRAs, that type of stuff. Because one of the problems is, like, for example, in our taxable accounts right now, we have some positions that are up about 11%, that type of thing. But we have a whole lot of positions that are up 50 to 140%. You can't sell those and get defensive because what will happen if you sell them is you'll end up with a big loss automatic because of tax. You could lose maybe 30% to tax between state and federal taxes, even on a long-term capital gain. And so losing 30% of your gains just to get more defensive doesn't make any sense. You're better off kind of a buy and hold there and maybe just draw a line in the sand. Hey, once it gets to a certain amount of gain, I'm going to take it and just, pay the tax. But we're at 50 to 140 on so many holdings. That's a good thing, right? If you have something at a loss, you could take the loss and bank it and be more conservative. If you have things at small gain, yeah, you could take that. But a lot of our taxable accounts have big gains. So those we want to kind of hang on to until things get really poor. So what I'm talking about right now, getting defensive, has a lot more to do with what we can do with no tax inside of an IRA or inside of a Roth IRA or those types of things. So, and that's what we're doing, and that helps as far as that goes. And that's a piece of the puzzle. It's why you want to have lots of different types of accounts, in my opinion, going into your retirement.